What's going on, my fellow wealth creators? Matty Guys here. In this video, we are going to have some fun breaking down what I believe is a pretty absurd LinkedIn post where this gentleman makes a pretty bold statement. He says that as a general rule, 99% of whole life insurance policies should be replaced with an IUL. Now, I've heard IUL agents make some pretty bold claims before. I got to put that one pretty close to the top of the list. That's a pretty insane thing to say, in my opinion. But we are going to break down the post, go through his arguments, and see if there's any validity to it. Spoiler alert: there's not. And you really have to be careful with this kind of stuff, guys. This type of content. This is one of the reasons I started this channel and I started making videos like this, is to share the other side of the story. Okay, because I almost purchased an IUL and put a lot of money into it because of content like this that just paints the really pretty picture of IUL and says it's so much better than 401ks and whole life insurance. It's pretty much better than everything out there, right? It's this magical financial product that's going to provide us all this tax-free retirement income. We can never lose money in it. All the upside potential, downside protection, from the market, whatnot. It's just like, it sounds really good. It also looks really good on paper. The problem is the majority of the content that is just talking about how amazing it is doesn't disclose all the things that can go wrong, all the risks involved. Now, here's the thing. When you understand the risks involved, it doesn't mean, like, just because there's risks involved doesn't mean you shouldn't do it. Like, maybe an IUL still makes sense for you. Maybe. In my experience, the majority of people, including myself, when they understand how IULs actually work, and there's a lot more to the story than what a lot of these agents are talking about and sharing. It's a lot more risky. There's a lot more things that can be changed and can go wrong. You typically don't want anything to do with it. And that was my journey, my story, because I was watching all this content about how amazing it was. There's not a lot of content counteracting that, telling the other side of the story, which is how risky these things can be and all the different moving parts that you need to be aware of in order to make an informed decision. Okay, a lot of people are buying these things based off of this type of content without knowing what they're actually putting their money into. That's the biggest problem I have with this stuff. All right, so let me share my screen and we'll go through it. We'll talk about, a lot of the different risks involved with IUL, a lot of the problems with some of the statements he's making here. And maybe we'll go through some scenarios where it might make sense to replace a whole life policy with an IUL. A lot of the times I don't see a case for that. Because what this gentleman is basically stating is that because IUL looks better on paper than whole life insurance, that's why they should be replaced. He doesn't really make a very good argument for why that should actually be the case. It's just an illustration looks better. So it should provide more income. And that's why, as a general rule, right here, he says 99% of the time, whole life policy should be replaced by an IUL. And that is just absolutely insane. That is just ridiculous. And again, that's not to say that there aren't some cases where it might make sense, but a lot of times it's not. Okay, so let's get into it. I think this is going to be really helpful for you guys. All right, he says Northwestern, Mass Mutual, New York Life. These are like top major mutually owned life insurance companies. They sell whole life insurance. Obviously, they sell more than that, but we're talking about the difference between whole life and IUL here when it comes to retirement income. All right, so they sell whole life insurance and do a great job training agents to be so friendly that policyholders don't suspect how a whole life policy underperforms as a supplemental retirement strategy. Okay, well, not really sure like the relevance of this when comparing how an IUL and a whole life policy could benefit a retirement strategy. But I suppose we could break down, to me, my interpretation of this is actually pretty condescending. It's a pretty condescending thing to say because it's basically stating that the consumer is so stupid that as long as somebody's friendly with them, they're going to buy the product. They're not going to do their own research. They're not going to ask questions. I guess maybe that does happen sometimes. I'm not saying it doesn't. But it just makes it seem like these companies are doing nefarious things to make sure that like the emphasis is on being friendly and making sales and not educating clients about how the product works. And it's not really much to do with the company. Sometimes it is. All right. But also, this is the case with IUL companies. It's really the case with all companies, not even just insurance. I mean, every company wants their salespeople to do well. Part of that is being friendly. You don't want to be a jerk to people. But, I think a little bit more highly of you than this. I don't think you're going to make major financial decisions based off someone just being friendly to you. Hopefully that's not the case. But yeah, I just I don't see the relevance there. And IUL companies do that all the time, especially, guys, these multi-level marketing companies that sell IULs, please be careful with them. They have such a strong emphasis on sales and recruiting, very little to do about educating you on how IULs actually work, and the risks involved and the things that can be changed, all the things that can potentially go wrong that will impact the IUL long term. Like, a lot of that is not discussed and disclosed with clients. It's all about the sales presentation and making money, recruiting, etc. So please be very careful with that. All right, so let's continue. A bad sign: you weren't given an initial illustration showing distributions in retirement. I don't think this happens very often, because I would agree. Like, I agree with this statement. If you weren't shown, like if you're looking at IUL or whole life, really any life insurance product, to add to your retirement strategy, and you're planning on taking income from it, then that should be, like, distribution should be included in the illustration. You want to see what that's going to look like. I would hope that's not happening very frequently, but again, this can happen with whole life, IUL. It really doesn't matter which one you're doing, but you do want to make sure that the agent is showing you distributions in retirement from a certain age, like in a certain time frame. All right, and that's whether you're doing whole life or IUL. All right, so make sure you see that. All right, because you want to know how it's going to impact your retirement, right? So we want to look at distributions. Now, his first step for you is to ask your agent for an illustration showing the maximum amount of income you can take from the policy every year from age 65 to 90. Let's call it X amount per year. And then he says, step 2, run an alternative IUL illustration. It should be, that's an interesting way to put it, but it will be quite a bit higher. It should be 2x, 3x more per year. All right, so it's going to provide you so much more income than a whole life policy will. It will also offer critical rider and long-term care benefits, as well as a death benefit, which whole life policies offer all of that. All right, and here's a statement. 99% of the time, whole life policies should be replaced by an IUL. It's also very ironic that he puts this quote here from this gentleman. He says, most of the lawsuits where I gave expert testimony involved unnecessary whole life policies. All right, if they look, there's bad actors in every single industry that you can think of, right? So I've seen very poorly designed whole life policies where people were just pissed off after I had a conversation with them, showed them how my policy was designed. It's like, yeah, that's what I wanted, but that's not what the person got, unfortunately. It's because the agent didn't know what they were doing. A lot of times it's all about, more commission for the agent, et cetera. Like, you do have to be careful whether you're doing whole life, index universal life. Heck, you have to be careful with 401ks, mutual funds, financial advisors. Like, you have to be educated. That's really the thing. It's not just about being careful. The more you educate yourself about these various different products and how they fit into your overall financial plan, the better decisions you're going to make, regardless of the intent of the person selling you whatever the product is. Right. So make sure you're educating yourself. But what's interesting about this, about him putting this quote in here, is that right now, like, he fails to acknowledge that there are massive class action lawsuits against IUL companies because of major deceptive marketing practices around index universal life insurance. Some of the more recent ones that I've followed and made content about on my video have to do with, like, these proprietary indexes and volatility controlled indexes and how they're illustrated and stuff. And it's just insane. It's absolutely insane the way some of these agents and these companies market these things, right? So yeah, I'm sure there's lawsuits about unnecessary whole life policies. There's also major lawsuits around index universal life insurance as well. So again, this is just really, really biased information here. But let's talk about the retirement income strategy here. Okay, the first thing I want to say about this. All right, whoops, what have I clicked the wrong frame there. The first thing that I want to bring up with regards to retirement income using life insurance, I don't know why there's such a huge emphasis on using life insurance as a primary retirement income stream. Life insurance is not designed to provide a ridiculous amount of income. And here's the thing: you're going to see a lot more income on an IUL illustration versus a whole life policy. So it's really not a fair comparison. It's not a good comparison, I should say. Because IUL, like I said earlier, it looks really good on paper, guys. And there's a number of different reasons for that. But let me finish the first part about the overall retirement strategy, like using life insurance for retirement income. We need to be realistic about what these products are designed to do. Okay, so when I think about retirement income, and I've done videos on this about like 401ks and using the stock market for income, like these aren't really good income vehicles, right? Can they provide supplemental retirement income? Sure. But they should never be the primary source of retirement income, which is what a lot of IUL agents claim with regards to IUL is because it shows all of this tax-free retirement income, right? So this is going to be the primary source of income for you in retirement. I'm not saying that's what this gentleman is claiming, all right? But he's kind of alluding to it, where you're going to make 2-3 times more the income, or you're going to get 2-3 times more the income from an IUL, just because that's what it says on a piece of paper, than you would with a whole life policy. And I think we need to be more realistic about what these tools are meant to do. You want to know what the best income vehicle is for retirement? It's annuities, because that's what they're designed to do. Now, are they good like wealth accumulation vehicles, like for growing your wealth? Not really. Like you're trying to use a tool for something that it wasn't designed to really be good at. So let's use these tools for what they're actually good at. All right. So if we think about whole life insurance, for example, it can provide supplemental tax-free retirement income in a couple of different ways. We don't even have to use policy loans. Now, can you get more income with policy loans? Yes. And what this gentleman mentioned earlier about showing it that those distributions from age 65 to 90, I would actually be a little bit more conservative than that, because when you're taking policy loans for income, there is that chance you could potentially lapse the policy if you're not careful, if you don't do it right. If you over leverage the policy, you could end up lapsing it and end up with a whole new set of problems. Potentially a massive tax bill. You lose everything you put into the policy. You lose all your coverage, all your benefits, right? We don't want to do that. Now, there's conservative ways to do it, right? Just make sure you're working with the right person. There's nothing necessarily wrong with taking policy loans from a whole life insurance policy for tax-free retirement income. However, there's other ways to do it. You could turn your dividend into a stream of retirement income, tax-free up to your basics. Now, I like that because I'm not like over leveraging my policy. Okay. The argument against it, though, especially from IUL agents, is that that's not enough income. But here's the thing, is if I'm not relying on my life insurance policy to provide the majority of my retirement income, then why do I care? Okay, now that's just me. All right. Maybe somebody, like based off their current situation, they need to rely on their life insurance policy a little bit more for their retirement income. Everybody's situation is a little bit different. So policy loans a little bit more aggressively might make sense. Right. But you have to be careful with it, because when you're taking policy loans, that interest is going to compound against you. Okay. Now, with whole life insurance, the good thing about whole life insurance, especially compared to IUL, is it's guaranteed to grow. Like compared to IUL, when it comes to retirement income, whole life insurance is guaranteed to grow and it gets dividends. Okay. Now, the dividends is not guaranteed, but these companies, especially the ones that this gentleman mentioned, have never missed a dividend payment for over 100 years. Okay. So we're pretty confident that's going to continue coming in. We don't have to worry about fluctuations, volatility in the stock market, and not having our policy grow in any one particular year. Right? These loans can especially the participating loans with an IUL, when you're taking that for using that for retirement income, that can pose a very serious risk to your policy. Okay, and here's why. There's a lot of issues with the IUL illustration, especially when it shows income, guys. And he's sitting here saying it will show 2 to 3 times more income than the whole life policy. That's just on paper, guys. It's what I call IUL fantasy land. Assuming everything goes right, assuming the market goes up every single year, which is normally how these IULs are illustrated, is they show growth every single year. Guys, when's the last time the stock market went up every single year? It doesn't. And usually the growth of an IUL is based on stock market performance. It's attached to some stock market index. Here's the problem with the IUL illustration showing distributions, and it's one of the reasons why it shows so much more income. It's because it's adding 50 basis points of positive arbitrage in the policy, in the growth of the policy. So it's showing growth every single year, and it's adding an additional 50 basis points of positive arbitrage between what the policy earns and what you're paying in loan interest. Because again, we're taking policy loans here. All right, we'll get to the wash loans in a second, because there's really 2 different types of loans that you can utilize in an IUL for retirement income. I will cover that. But 99 times out of 100, 99% of the time, agents are showing participating loans for the income. Why? Because it makes it look so much better on paper. Because it shows that growth every year. Because it adds the 50 basis points of positive arbitrage to it. So it's assuming the policy is growing by an additional 50 basis points over whatever the loan interest is every single year. Guys, can we just use a little bit of common sense here? Like, do we really think that's going to happen? Is our IUL going to grow every single year? Because the stock market doesn't go up every single year. So it's very, very misleading. Okay. And here's the other reason why these participating loans for the retirement income, okay, because it looks really good on paper, are such a huge risk to the policy. What happens when you do have a 0 year, when the market does not go up, when we get brought back down to earth, brought back to reality? The market does not go up every single year. We've been taking policy loans to create that income, okay? And a lot of the times, these IUL illustrations show very aggressive income because it shows it growing every single year with that positive arbitrage. But what happens in reality when that doesn't happen, and we've been accumulating this loan balance? Let's say we've been taking $50,000 a year in tax-free retirement income via these policy loans from our IUL. We have a $250,000 loan balance. Now, as long as our policy is growing, it's not really an issue. But what happens when it doesn't? And all of a sudden, so we have fees and expenses that are still due in the IUL, cost of insurance, whatever normal fees and expenses for having the policy are. All right, that's going to reduce our cash value. But now we also have this loan interest cost. Let's say it's 5%. What's 5% on $250,000, guys? I can't do that off the top of my head, but that's a pretty significant amount of money. Where's that coming from? It comes from your cash value. So you can end up taking a pretty major hit in your policy, and that can increase your net amount of risk, which then increases how much you're paying for your cost of insurance, which is getting more expensive every single year, and it can end up being this downward spiral. Okay, now, am I saying that's absolutely what's going to happen? No, but that's a much more realistic scenario that you need to be aware of that could happen, so that you can make, again, an informed decision on whether or not you want to take that risk. Okay. A lot of these agents don't talk about that. They only say, look how amazing it looks on paper and how much better it looks than whole life insurance. And look at all this income that you're going to get. Guys, I remember seeing when I first got into this business, I had an IUL illustration presented to me because he found out that I had whole life. And he's like, I can beat the crap out of your whole life policy. Watch this. And he showed me taking it was like some ridiculous amount of income, like $250,000 per year, starting at age 65 and taking $250,000 per year for the rest of my life. Now, I fund my policies pretty aggressively, but I would have recouped all of my money that I put back into it in 5 or 6 years. And that's going to realistically continue for another 20 years while I'm in retirement. I don't think so. So I don't care how good something looks on paper. I want to make my decisions based on reality. What's more likely to happen here? Okay. So you have to be really careful with tax-free retirement income from a life insurance policy in general. We want to be realistic about it. But especially with an IUL, guys, if they're showing you taking participating policy loans to create that income, it's not showing any 0 years on the illustration. It has that 50 basis points of positive arbitrage. Those are very, very big red flags, guys. And it's a fancy illustration. That's all it is. It's not it's not based on reality. Another thing too, kind of a side note, but this can absolutely impact the amount of income that you can take from an IUL also, is let's say you've had the policy for 30 years. Okay. Well, one of the things that these life insurance companies will do with these IULs is adjust and lower cap rates, participation rates, spread charges, no risk rates, all these things that you have no control over, that the life insurance company can adjust to manage their risk. So what happens when this illustration is given to you? It's showing all this income based off the fact of you having a 12% cap rate. And we're just going to keep it simple and use the S&P 500 index. Okay, year to year, point to point, whatever. All right. Well, what happens to that illustration? What happens to the amount of income you're able to take if the life insurance company drops it to 10%, 9%, 8%? If you don't think that can happen, let me break it to you here really quick. Let me share my screen again. All right, because this happens all the time. And I've shown this chart a few times on my channel. This is just an example of what some of these carriers will do. All right, let's look at some of the more recent ones, like 2011. So John Hancock, Allianz, like all these different companies with these IULs. Here's the products. All right, this is what they started out at, the cap rates. All right, so S&P annual point-to-point cap rate. Inception year. All right, so in 2014, Allianz Life Pro Plus, 11.5% cap rate. In 2024, it was 9.5%. Dropped it 2 points, 17% difference. And you know what the really egregious thing is here? Is when they sell their new IULs, they're selling it at 12.5%. So new policyholders are getting a 12.5% cap rate while you sit there with a 9.5% cap rate. You're the loyal policyholder. You've been making your payments, doing everything that the agent told you to do, but your cap rate is still lower. New policyholders are getting the 12.5%. That's just crazy. But here's the point, is what does this do to the long-term performance of your policy? If your cap goes from 11.5% to 9.5%, how about some of these other ones that are just unbelievable? How about from 11% to 5.25%, 14% down to just roughly 7%? That's like cut in half. You know what's crazy is a lot of the times these IUL illustrations in their non-guaranteed column will show a conservative growth, like compound growth rate of 6.42% or 6.5%. Well, riddle me this. How are you supposed to get an average of 6.5% every year in a product that does not go up every year? But if you're capped at 7%, if you're capped at 9%, the math does not make sense, right? And that's why these products look really good on paper, but it's such a problem because it's just an illustration. It's not what's actually going to happen in reality. The reality is that a lot of the times these companies lower cap rates and all these other different things in the policy that have a major long-term impact on the performance of the policy, which is obviously going to have a major impact on the amount of retirement income you can take. So now all of a sudden you've been making plans around this amazing product that you have, but 5, 10, 15 years into it, you run an in-force illustration, it's not doing anything close to what was originally illustrated. And now all of a sudden your retirement plans are falling apart because you've made those plans based on how amazing this product looked on paper. Okay. So all I'm trying to do, guys, is give you the facts about how these things work, the things that can be changed that impact the performance of the policy so you can make a better decision. All right. Now, I do want to finish up with the IUL, taking income in retirement for an IUL using wash loans. Okay. Now, I encourage you guys, I'll drop this down in the comment section or the description below. I did a really good interview with an IUL agent. He's not even an IUL agent. He's an advocate of IUL, but he's pretty product agnostic for the most part. It's basically just, he tries to figure out like what product is best for what the client is trying to accomplish, which I think is great. All right. So, but we had a really good conversation, and the way he illustrated an IUL is what I believe is how an IUL should be illustrated, where he put 0 years into the illustration, all right, making it a little bit more realistic. And also when it came to taking retirement income, he used, actually first they did a withdrawal to basis. Okay. So basically all the money that they put into the IUL policy, they just did an actual withdrawal. All right. So there's no loan interest cost there. You can do that with whole life as well. All right. But then after that, in order to keep the income tax-free, that's when we start taking policy loans. But he didn't illustrate the participating loan. There's a wash loan that you can take with IUL in order to create that income as well. Now, the reason this is oftentimes very frequently not illustrated is because it doesn't look anywhere nearly as good on paper as it does taking the participating loan, which shows the policy growing every year with the 50 basis points of positive arbitrage. So that's why a lot of the times they don't show the wash loan. But the wash loan, in my opinion, is a little bit better because you're not accruing that interest cost. And so when you have that 0 year, you don't have an interest cost on the loan balance because it's a wash loan, meaning the interest rate on the loan might be 3%. So the life insurance company is going to credit you 3%. It's just a wash, right? That's why they call it a wash loan. All right. That is much more conservative because you don't have this massive loan balance where you have $250,000, $300,000, $500,000 loan balance with a 5% interest cost all of a sudden. And guys, it doesn't take long to get to that size loan balance because, again, these policies, these illustrations are very aggressive with the amount of income they show, which is why he's saying it should be 2-3 times more income than a whole life policy with an IUL. Yeah, they're really, really aggressive with it. They're assuming growth every year, and it has the positive arbitrage to it. So you can use wash loans with an IUL for that. Nothing that has its own issues as well. I'm not going to go down that rabbit hole, but it's important to understand the different options you have available, so you can see what you know what you're looking at when it comes to these illustrations, guys. So I guess I'll go ahead and wrap up with that. Those are my thoughts on retirement income using life insurance. I guess what I will wrap up with is that, again, going back to what these products are designed to do. All right. I'm not saying we can't use them for retirement income. It should be supplemental. It should not be the primary source of retirement income, guys. But when I think about whole life insurance, I see something that can be a really good volatility buffer in retirement where, maybe you have your 401k, IRA, you have your stock market investments, your mutual funds, whatever, that you're now going to start to sell off once you hit retirement age. Okay, but what happens when the market tanks? We don't want to sell into a market decline that's going to drastically reduce the longevity of that portion of our retirement portfolio, right? We want to give the market time to come back. We don't want to sell into the decline. So we need what's called a volatility buffer. Whole life insurance is phenomenal for that, because now we can take withdrawals, we could turn our dividend into cash, we could take policy loans for our income that we were going to take from our portfolio, like our stock portfolio. But since we don't want to sell into the decline, we're going to take our income from this whole life insurance policy, okay, which is much safer. It has nothing to do with the stock market whatsoever, which is why IUL is not that great of a volatility buffer, because when the stock market tanks, that means your IUL is probably not going to grow. It doesn't compare very well to whole life with these things, because a whole life policy is guaranteed to grow, plus it gets dividends. So I could tap into that while I wait for the market to come back. And then when the market's back, it's in the bull run again, whatever. Now I can start resuming income from the stock portfolio. All right. So fantastic volatility buffer. Also, whole life insurance gives us permission to spend these other assets down much more freely. Why? Because we don't have to worry about passing on these assets to our loved ones, right? The whole life insurance policy is going to do that. They're going to get an income tax-free death benefit when we pass away. So instead of being stuck on this 3-4% rule, because we have the volatility buffer and we have the death benefit, maybe I can do 5 or 6% now, and I can spend my assets more freely and actually enjoy my retirement, right? Do the things that I wanted to do, right? So there's that. There's also long-term care coverage benefits, like which IULs have as well, but that's assuming that your IUL makes it to retirement. That's a whole other video. But anyways, if you get diagnosed with a chronic critical terminal illness, you can accelerate a large portion of the death benefit. So it gives you some to get the care that you need. So there's some long-term care protection there. And like I said, you can turn your dividend into a supplemental retirement income stream as well, which, is it as much as a policy loan would be, or as much as an IUL illustration shows that I can get? No, but I'm okay with that because I have a realistic expectation of what this product's going to do for my personal finances. Right. So anyways, I hope that was helpful, guys. Like I said, my point with this is just to tell the other side of the story so that you can make an informed decision. If you still want to roll the dice with an IUL, go for it. But I just don't see it. I don't see a valid argument for IUL. There's not enough additional potential reward for the risk that I'm taking, all of the unknown variables, all the things that I can't control, right? With whole life, at least I know it's guaranteed to grow. I'm going to get the dividends. I'm okay with my, if it's 4 or 5%, whatever. If I could get 6-7% in an IUL, is that worth the additional risk? To me, it's not, right? But you are the one that has to make that decision. If you guys have any questions, drop them down below. I'd love to get your feedback as well. Let me know what you think about this. So just be careful out there. Do your own research, and I'll talk to you in the next one. To your success, Matty Ice is out.